Hey guys, it's Ryan Samudia here, and in this video, I want to go over temporary buy downs, how they work, and how they can help buy you time during a less than ideal mortgage rate environment. All right, the technicalities will be at the end, so for now, we're going to get right down to it. Okay, so for demonstration purposes, we are going to assume that you have an interest rate of 7.5%, which is very common rate today using a 30-day average. Right. So let's say you go under contract, and congratulations on that, by the way. Sooner rather than later, we want to lock the rate and stop playing victim to the daily fluctuations of the market. All right. The locking process is unchanged. I will look at the most competitive investors for the day and present you the options that I believe are the most tailored to your particular goal, whether that's the lowest cost, the lowest payment, or maybe something in the middle. All right. So that's where temporary buy downs come in. Okay. What we do is we take there we go. We take the interest rate that you locked and reduce it for a specific amount of time, typically 1 to 2 years, but up to three based on the concessions that we have available. So here's the breakdown. You locked a 7.5% rate. A 1 and 0 buy down would reduce your interest rate by 1% for 1 year. Using a $400,000 purchase with 3% down as an example, this buy down would save you $260.53 a month, or $3,126.36 for the year. Therefore, you would need that much in concessions to make this buy down happen. Now, if we got a $2,000 seller credit, then that's not enough to cover the subsidy. Does that make sense? So that gives you the number to shoot for with concessions if a temporary buy down is your goal. This is the same principle with a 2-1 buy down and a 3-2-1 buy down. All right. So with a 2-1 buy down, same example, 7.5% locked rate. You reduce your rate by 2% for the first year, aka the first 12 payments, and then 1% for the next. So 5.5 for 1 year, 6.5 for the next, and finally on the 25th month, you're back to the 7.5% rate. So same house, $400,000 house with 3% down. The 2% reduction for 12 months would save you $509.93 a month for the first year, which adds up to $6,119.16. Then you have a 1% reduction for the following 12 months, which, as we already discussed, saves you $260.53 a month, which adds up to the $3,126.36. So that means the 2-1 buy down would require $9,245.52 in concessions. So if we had 8,000 in concessions, for example, we wouldn't quite have enough for a 2-1 buy down, but we could do a 1 and 0 buy down and then use the leftovers for other closing costs. Now, I get this concern a lot. This sounds like an ARM. All right. Hey, Ryan, this sounds a lot like an adjustable rate mortgage, and I don't want an adjustable rate mortgage. It's not. You lock the 7.5% rate. That's not going anywhere. We're simply taking the money that we're receiving from the seller and we're slowly dripping it into your monthly payments to pretend we have a rate that is 1 or 2 percentages lower than what it actually is. Which leads me to my next frequently asked question. Ryan, this sounds pretty good. If I don't have concessions, can I just buy a temporary buy down for myself? Yes and no, right? Going back to the idea that you're not actually buying the rate down, if you're dripping your own money each month, then you can achieve the same thing by putting those $9,200 in a separate bank account and withdrawing $509 each month for 12 months and then $260 for another 12. The point is, you're not really saving anywhere. You're using your own money to create the illusion that you're saving. When you're using somebody else's money, then it's not really an illusion anymore. The savings are very real. All right. So if you refinance before your buy down period is up, which is the goal actually with this strategy, hence buying you time, then any funds left over from that subsidy will go towards your principal. So no, your leftovers will not go to waste. Temporary buy downs are eligible for all loan types. On jumbo loans, you just want to make sure that your investor allows them. They get a little picky with it. All right. They are, however, only available for primary residences, no second homes or investment properties. I think that about covers it. So please call or email me if you still have any other questions. All right.